Money Radio for a really great future. We're talking real money.
Wouldn't it be nice if you could get everything you wanted from your investments? Wouldn't that be a wonderful world? And we all dream of such a wonderful world, a magical place where you can invest your money and yet not worry about the market going down. You get to make money when the market goes up, but you don't lose it when it goes down. The dream of every investor. Except, your real dreams, when you wake up and you go, oh, yeah, none of that stuff actually could happen in real life. Well, that's the case with any investment that promises to protect you from the downside while still delivering the upside.
And for me, by the way, it's not money, it's chocolate. I want that thing where I can eat all the chocolate I want, not ever gain any weight, and this never happens.
You do love your chocolate.
I know, I do. So that would be my dream, and I guess there is a shot now kind of for that, but I haven't tried that aspect.
A chocolate shot? Yeah, you could get like chocolate liqueur, a little shot.
Shot in your mouth. All right, so this is fascinating to me because, yes, this is what everyone wants. And guess what? They're being sold this all over the place. Americans have poured money, this is from the Wall Street Journal, into funds promising shelter from the stock market's wild swings. And then, as the Journal correctly points out, they don't always work as expected. What are we talking about here? Equity-hedged, exchange-traded, and mutual funds.
I mean, just the fact that it's got the word hedge in it.
Yeah. Tell you what you need to know.
It means it's not shrubbery. It means
two-level effect.
Hedging is a word that is used for, I think it really does replace magical. And if they used magical fund, you wouldn't believe it. But they throw in the word hedging and you believe it.
But you might take one instead of the chocolate. But that's a whole other thing. Guess these fascinating that now $56 billion are in these funds. That's double what they were just 5 years ago. And I guess because people want this, another 24 have launched in the last year and a half. And guess what Wall Street does? They play to your fears. They advertise them as protection against scary times in the market, kind of like stock insurance. And the Wall Street Journal, thankfully, has pulled back the curtain a bit and points out that between the high fees and complicated strategies, some haven't delivered as well lately as just staying invested and compounding returns. In other words, having the right balance between stocks and bonds. Now, one of the folks that's been out on the hustings sort of picking on these is Cliff Asness from AOR Capital Management. AQR, pardon me. They've analyzed some of these with at least 5 years of performance. And by the way, there aren't that many with 5 years. And they found the majority, most have failed to deliver either better returns or less severe drawdowns than a portfolio of stocks and bonds. That would not surprise you. And another thing that wouldn't, Don, I mean, I'll let you respond to all this here in a minute, that half of them, again, more than half, have expense ratios of more than 1%. Remember, this is a time when you could go buy index funds for 0.03% of 1%. The numbers are really low.
The Vanguard S&P 500 is 0.03% of 1%. VOO.
Yeah. So you can do the math there.
The Invesco 500 downside hedged ETF.
Yeah.
PHDG it's not a ridiculous expense ratio, but it is more than 10 times higher than VOO at 40 basis points.
Yeah. It's crazy.
4%. But here's the rub. It's how it has performed. They're saying you're going to get the kind of the market, but without taking the risk. Now, that's a bit misleading because the Vanguard 500 Index ETF, VOO, has posted a 10-year average annual return. That's how long it's been around, of about 13% per year, according to Morningstar.
Pretty healthy. Yeah.
Yeah. Now let's look at the VO or the PHDG, which is the S&P 500 just hedged against risk. 10-year average annual return. 4.33%.
Yeah, but if that's not enough, look at something like the Invesco S&P 500 downside hedged ETF.
That's the one I'm looking at.
Oh, okay. But but more importantly, okay, pardon me, because you didn't read it exactly the same. More importantly, I think on this is the protection it offers, because that's what people really, I might take a little less, but protect me from the downside. This is a $100 million fund, has $100 million bucks under management, that promises positive total returns in rising or falling markets. Well, that fund is down 8% this year, far worse than the S&P 5. In other words, it's done worse than the index that it's hedging for. I mean, that to me just doesn't make sense, right?
Right. And the other incredible thing is that, okay, sure, the hedged fund is going to give me reduced volatility. It's going to be less scary. Okay, so we measure volatility with standard deviation. The standard deviation over 10 years on the S&P 500 is about 15.5%.
That's what you should expect.
The volatility on the Invesco, the symbol's PHDG, the Invesco S&P 500 downside hedged ETF. The 10-year standard deviation on that is 10. So it's a third lower, but you get 1/3 the return. It has a 2/3 lower return.
Yeah, that's the number you should pay attention to. But let's talk about sort of the underlying reasons why, because I think people don't understand how these funds are operated. And if they did, they might be questioning a little bit more. Most of it is options, right? They're buying options on particular stocks, and you got to pay up for those, and that chips away at the returns. That's what AQR found. Protection often weaker than simply, as something we've talked about many, many times, reducing your stock holdings. In other words, having less in the riskier things like stocks, more in bonds. Your return expectation should be lower, but you should also have less ups and downs. And I think it's a little more honest with yourself, because this is truly a magical pill. But talk about the options aspect of this a little bit that I don't think people understand.
Because options get very confusing. The way you hedge against a decline, the safest way to hedge against a decline in the value of a particular stock is to buy what is called a put option. A put option allows you to, at some point in the very near future, they don't run long term, to sell the stock back to the person who sold the put at a particular price, so that you protect yourself from any downside. Over that period of time, if the stock drops a lot, well, this person who sold you the put is required to buy the stock back from you at that higher price from the past. However, every time you buy a put option, you have to hand over cash permanently. You pay for that every time, and you pay for that out of the assets of the fund. So if you're buying options every 6 or 9 months, you're spending $1 or $2 a share, the share of the stock, to buy that option. So if your stock doesn't go way up and it doesn't go way down, well, you're actually reducing the return of your portfolio by those premiums you're paying to buy the options that just expire worthless because you never used them.
So there's an aspect of price and about timing that it sounds like as well, about making sure it's the right period of time.
Yeah, exactly. And there's a strategy to that, but the strategy can fail. And as a matter of fact, I can tell you from personal experience that option strategies may seem relatively conservative, but over a long period of time, they can be incredibly risky, either from a cost standpoint or a volatility standpoint if you're playing. Depends on which side of the options you're playing.
And in fact, AQR, again, the people that have looked into this closely, they claim 78% of these funds, that's about 8 out of 10, tied to options fared worse during this year's steep market decline than a portfolio mix of stocks and cash. That's according to an analysis through April. So what are our takeaways here? I love the quote here. It says, many have perceptions, likely misperceptions, on what these products do. I think that's they buried the lead. That should be in the first paragraph, but they put it in the last. But what do we take away from this? I take away, by the way, something that we try to make sure you're clear on, that we truly believe in. That is, most of the time when it comes to investing, simpler is better.
Oh, yeah. Absolutely, because the more complicated it is, the more money a lot of different people are making along the way to pay for that complexity. And I just want you to look at the numbers. That's what I really want you as an investor to do. And if you look at, for example, and this, we don't recommend the S&P 500. We're just using it for comparison purposes right now because the Invesco fund we're picking on is an S&P 500 hedge fund. If they're hedging against the downside, then you're going to lose over long periods of time because in the markets, at least that we have seen over the past 100 plus years, the downside happens less than the upside. I mean, for example, let's go back to 2020, just 5 years.
Yeah.
In 2020, the S&P 500 was up 19%. In 2021, the S&P 500 was up almost 16%. In 2022, it dropped 14%. In 2023, it was up 8%, and in 2024, up 11%. Now, that meant you only had one bad year in there.
Then that's about what you should expect. 1 out of about 4, looking historically, you should have a down market or have had a down market.
And then, but if you look at the fund, I'm sorry, I was looking at the fund. If you look at the S&P 500, that was the fund. If you look at the S&P 500, they were up in 2020, 18%. In 2021, 28%. In 2022, down 18%.
Sure.
In 2023, up 26%. And in 2024, up 25%. And remember, in 2022, the hedged fund still lost 14%. But in 2023, when the S&P 500 made 26%, your hedge fund made 8%.
And that's about holding to the numbers you mentioned earlier, about 10% return or so for the index and about 4% for the fund. So again, my bigger takeaway though for that, Don, is in this year, which is the year that you would hope, hey, this is where it's really going to pay off, right? Because the market took a big downturn with the tariff announcements. That has not been the case. So number one, for me, simpler is better. Number two, you spent some time unpacking this and the reasons why costs really do matter. And
and by the way, those option costs are not included in the expense ratio.
Exactly. That just
those actually come out of the value of your portfolio separately. So they don't show up in the costs.
No, that's the cost is what they're putting in their pocket. And that brings me to number 3 and something that we have spent many years trying to make clear, but apparently the 56 billion doesn't believe it. There is no panacea. There is no one magical pill. There is no one sort of hand me your money and we'll make sure you're protected on the downside and you'll still make market on the upside. In the end of the day, and Dr. Fama's told you this, I've seen the video, that what you should be doing is first deciding on what rate of return you need for your money, what's going to be important, your risk tolerance and capacity, and then building the right balance between stocks and bonds and rebalancing it, and that's it. You're not going to get into all these sort of fancy hedge option strategies that have ended up not doing as well as just a balance between stocks and bonds.
The heck with Dr. Fama. What does Dr. Phil say?
I didn't get a chance to get him on the phone.
Get Dr. Phil's opinion on these things.
2 doors down on the left. I'll stop in.
There's the magic doesn't exist. You can dream of it. You can wish for it all you want. But every time you go chasing it, you're going to end up, if not just a little disappointed like this, totally wiped out in some cases. So the onus has to be on you. Don't think, oh, well, somebody's going to protect me from all these bad things. Nobody's out there protecting you. Misconception. It's on you. The onus is on you to make sure you make smart decisions with your money. Nobody's going to make them for you.
Yeah, I think that's a good takeaway. By the way, we're going to do a couple of questions, and I'm first going to apologize because we have a lot of questions now backlogged because somehow the questions were going to a different inbox, not mine anymore. That's now been fixed again, apparently. And so some of your questions, the ones I'm going to start reading, may be a couple weeks old. I do apologize for that. We'll figure out a way to catch up. Maybe we'll do another Roxy program or something, and we'll spend some time on Saturday. Anyway, so we'll figure out to get through them. But Ray writes us from Royalton, Vermont. We don't get a lot of questions from Vermont.
Well, it's not a very big state.
That's maybe why. He says, we do not know if we might be beyond the income limit for a Roth IRA contribution in 2025, which I think we've looked into this before. Individually, it's like 160 something for a couple. If you make more than $230,000 or something, you cannot contribute to a Roth IRA unless you're using the back door. Then he asks, is it possible, or is there any downside to making a non-deductible IRA contribution in 2025 and then converting it to Roth in 2025, even if our MAGI ended up below 236 for the tax year 2030? Oh, okay, so 236 must be the max. In other words, should I go ahead and do the backdoor Roth now and see what happens with my income? I personally would suggest, and I guess I should be asking you the question instead of asking and answering it. I would wait till closer to the end of the year and then make a decision.
Save me some work,
which I'm always trying to do, as you know.
No, really. Why would there be a downside in doing it though? Because the only problem is that sometime during the course of the year, the only downside to a backdoor Roth versus just doing a regular Roth is the fact the pro rata transfer or conversion of any regular IRAs you might have. So if you have regular IRAs, the downside might be that you're going to be stuck pro rata converting those. But if you don't have any regular IRAs that are going to get hit with that, then whether it ends up by the time you file your taxes being a regular Roth contribution,
not going to matter. It's a good point.
It's not going to matter.
Yeah,
it's just not going to matter.
Make the contribution, get it over with. For those of you doing any Roth contributions, any contribution, if you have the money today, get it in there.
Start now, because we don't know what the market's going to do, but we do know that time in the market tends to be better than time out of the market.
Timing the market.
Yeah. Or timing.
Dennis writes us from Apex, North Carolina.
I know where that is.
Oh, do you really?
Yeah.
Where is Apex? Apparently it's in the apex, I guess, huh?
Well, it's right around the center of the state. It's at the apex.
Okay, it should have been. I guess I should have known that. Writes us, I know you guys promote AVGE.
No, we don't. We like it.
We mention it. We think it's a good one fund solution for smaller amounts.
We get nothing for mentioning AVGE. We just like the fact. And by the way, it was habit because there was no DFAW at the time.
So we should make sure that we balance that out because we like both those funds. But the question is, he says, I guess I'll change the word like AVGE, but he says, I'm considering GLOV. AVGE has an expense ratio of 0.23. GLOV is 0.25. I get that. AVGE year-to-date performance is less than 5%, while GLOV is almost 10%. Morningstar risk rating 73 for AVGE, 57 for GLOV. Why would I not choose GLOV over AVGE?
It's not the same fund.
Did you see one big difference? I did look this one up because
one is it only has about 450 stocks in the portfolio.
Yeah, and I think if you look into it, AVGE probably has in the
thousands.
Yeah, well,
I would
least
guess
the thousands. It might not be 13, but probably 8,000 or 9,000 stocks.
Oh, that's right, because they do throw out a bunch of stocks, but it's in the many thousands.
Yes, whole different tier.
This is apples to grapefruit.
Yeah, okay. Well, we can't even go
apples to orangutans? I don't think it's that different, but
trying to bring the animal kingdom into the story.
Apples to orangutans.
But they do have some of the similar things. They have a value tilt, right?
Yeah, I know, but they do it in such a way that they don't have much of a portfolio.
Well, no, and I think this is a clear case of active management. They're picking stocks versus a more passive index approach. And we're always going to side with the indexers because we don't trust anybody picking 400 stocks.
But we have to be so careful because, of course, Avantis is not an indexer.
Touché.
And while we treat it as such because it's definitely a rules-based thing. And what's really funny is that GLOV calls itself a passive fund.
Wow. I'd love to see the rules that come up with the 440 stocks.
I have no clue. But that would be the reason I wouldn't get it, because I would rather have more than less.
Yeah, we'd rather be more diversified.
That more. I mean, here's the other problem is when you're making comparisons like this, they really don't work very well because of the short time frame you have to work with.
I would not be looking. I should have mentioned that too. Year-to-date performance doesn't matter to me. It's how the fund is operated. Yes, you correctly point out expense ratio is important, but there's so massive diversification in AVGE compared to the GLOV, GLOV, that that's an easy decision for us to make.
And I'm looking at, both of them have been around almost exactly the same amount of time. And again, GLOV is a far more focused portfolio. It
and
really is.
Who runs that one? That's
Goldman.
Goldman. Okay, that's
Goldman.
Yeah.
So you would expect more out of a more focused portfolio during good markets. Problem is the down ones. I'm not making any predictions at all, but I look at the performance and
how about for the time they've been in business? Is it similar?
It's again GLOV beats it because it's a more focused portfolio.
Been in the right stocks,
yeah. But the problem is that AVGE has what does it have? It doesn't have a full 3 years yet. So we can't really we don't have a lot of good comparison time, but
I would
again,
still rather own
they're different funds.
I'd still rather own the rules of AVGE than GLOV, no matter what the performance has been the last 3 years.
I would honestly expect GLOV in good markets to possibly dramatically outperform because of the focus of the portfolios.
Yeah.
I would. But you see, when I'm building a portfolio for me personally, I'm looking for massive diversification because that has shown to be more protective against volatility. Having more has been in the past better than less.
Yeah, Dennis, this is a great question, and I think you can clearly see we're going to support the Avantis or Dimensional Funds product.
I was going to say, throw in DFAW.
Yeah. Yes, we've got to be nice.
And we don't really care about the track record. That's what
it's hard for people to understand that because they're going to go back and say, well, this one's done better. And by the way, this year-to-date performance, meaningless. 3 years performance, probably meaningless. I mean, again, the academics who have studied these things are going to say anything under 10 years really is noise.
And let me just throw a number at you because numbers are kind of fun to look at. The GLOV fund, in the past full, not year to date, but 1 year, 12-month return, 18%. The 1 year return for both DFAW and AVGE is closer to 12%.
And again, I think what you point out is that's probably what you ought to expect.
Right. I actually expect less from a less tightly focused fund.
By the way, like my relationship, if you expect less, then your life will be more satisfying. So,
yeah, my expectations for my whole portfolio, my best case expectations for my balanced portfolio, which I think mine's about 60-40, is 6 or 7%.
What about expectations for your life, high or low? That's what I was trying to get to.
Low.
Okay.
Low.
So you're going to be very satisfied. You're going to be very happy.
Very low. If I wake up, I go, good day. Good day.
Sorry, I didn't mean to be.
Good day.
There.
It was a great day.
All right, fair enough. So there you go. Thank you, Dennis. Great question.
And if you have any others, just go to talkingrealmoney.com and send them in.
Keep sending them.
Or call us on Saturdays from 3 to 5 Eastern at 855-935-TALK when you can talk with us live. So, see how easy that is?
That's very easy. And if you want a little extra help, simply go to Meet
an extra helping.
An extra helping of
please.
Mediocre life. You get it right here every day.
Might I have a smidge more, sir?
Just one little tiny wafer.
I need just a little more help.
So if you want some help, like personal help, go to Talking Real Money.
Dr. Phil.
Dr. Phil. He's not in the building. Click on Meet an Advisor. We do that stuff free too. And I think you end up liking it. So.
Okay. Thanks for being a part of the program. We really appreciate you being here, and we hope you'll tell a friend or two or many, many, many of them. And, by the way, here's the little beg. Ready? Ready for a little beg?
Oh, please. Yeah.
Another guy. We have another guy who writes negative reviews and then re-ups them whenever. Like if we talk about crypto, he comes back with another. You guys are a bunch of idiots because you talk about crypto. So he disagrees with us. I get it. That's fine. But what happens is their 1-star review kicks back up to the top. So it's like people go, oh, 1 star.
Nobody likes them.
So leave some nice reviews. All of you who call in and say, I like you guys. Well, then type it up or just hit 5 stars.
And somebody, by the way, at lunch yesterday.
Apple Podcast, by the way.
Apple Podcast. Somebody at lunch mentioned crypto and said they think crypto is generational, that old people like us are never going to accept it, but the younger, they're going to go with it. Buying that?
Even though they can't spend it. That's
Doesn't
like
matter.
saying,
you're old.
Okay,
get over it.
Here, give me all your money.
Yeah.
And I'm going to give you some bills that I printed up, Don bucks, that no one will accept to buy anything.
El Salvador.
I don't think they even take it anymore.
Oh, they're done.
So, I'm going to give you money you can't spend. Do you want it?
No, but can I have it in an exchange-traded fund in my 401k? Would that be okay?
That's a different story.
Right.
Yeah,
okay,
sure. If I
good.
can make money on it, then it's another thing entirely. I can't spend it, but I'm going to make money on it. I'm sorry. I have a hard time wrapping my head.
Now here come the bad reviews again. They're coming. They're coming for you, my friend.
I don't want money that I can't buy something with without paying someone 8% to turn it back into the money that I can use to buy things. Am I missing something?
No, I think it's you're old. Just leave it at that. That's what they said at lunch yesterday. We're old, and we don't want to.
All right. Thanks for being there. We'll do another one of these days, probably tomorrow or a couple of days from tomorrow, one or the other. I'm Don. Look at that. That's Tom. We're in 2 different parts of the country, and yet we hang out together talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.